Hey guys, welcome. Hope you're having a great Thursday wherever you are, and sun's shining, and your AEP and your business is all going really good. But welcome. Really glad you took the time to spend a few minutes here with us. And I got today the famous Andy Thomas. Andy. But Andy is a local guy here and has helped Jeff and I tremendously in the last few years in our business planning and tax planning, and does all our accounting and
all the fun stuff,
all the really good stuff, man. So, but good guy. Really glad he's here. And we want to get into some of the tax questions and implications of selling your books. And so Andy's the man for that.
Thank you, John. Yeah.
Right?
Yeah.
You're the guy.
Give it a shot.
That's right. So what I thought we would do is, just like always, if you have any questions, you can type them in and we'll kind of get them as we go along. Jason will read them off and we'll kind of hit them as we go. So feel free to do that, guys. And then what I thought is I would just start and do just like a 5-minute little review here before we turn Andy loose on the tax stuff. So really, what we are really interested in is in acquiring more books of business and then servicing those customers from here. And to date, last two and a half years or so, we've done 6 books like that. Six different individuals were ready to retire. And so we were able to work it out with them and put it together. And now we're taking care of their customers from here. We love that business. And I can speak, I feel 100% confident that the guys that we've worked with, that they've really been pleased to and feel like they've been treated fair, and they feel like their customers are getting really well taken care of, and everybody's winning. So here's kind of what these have looked like so far, just really quickly, is so far, 5 of the 6, how we've acquired them is that we've bought them over time. And so how that works is we came to a valuation of the business, what we both agreed it was worth, what it was valued at. And then we agreed to pay over a 4 or a 5-year period. We agreed to pay a guaranteed amount every month for that 4 or 5 years, no matter how the book performed. Okay. And one of them we have is paid off. That gentleman passed away, but so far we really like those, and we would take absolutely all we can get of that. So that's just cash over time on a guaranteed basis. So then another one that we've done just once, but we are welcoming and have the ability to do as many as we need to do, is if somebody says, I just want all my cash up front, give me the money, show me the money, Andy. So the same thing, we come to evaluation, we both agree this is what this book of business is worth. We both feel it's fair, we feel good about it. And then just one check, we can pay that person off all up front. Now that could be somebody that's retiring, although probably not as likely, but maybe somebody that does have a health issue. Maybe they just went out of the business, they're younger and they don't want to be in the business anymore. And they say, hey, I'm ready to move on and do something else, and I need my cash right now to do something else. So the same way, we can put that valuation and just pay them in a lump sum. Those 2 are easy. Now, this third way, we're just getting into, and we're real excited about it, because really the toughest thing, guys, is to decide that you're ready to retire. So we have just found that out over and over again, that what I'll hear from an agent is, gosh, I'm not quite ready yet. I think maybe in the next couple of years, maybe 2 or 3 years, I'm going to be ready to go, but I want to have it all together when we get there. And so what we've been kicking around is, what if we could come together on somebody like that? Maybe that's somebody that's listening right now that says, I'm not quite ready yet, but I know in the next 2, 3, 4 years, I'm going to be ready to be done, that we start it now. That we go ahead and value your book, come up with a great valuation that we both feel good about, pay you a big chunk of money up front that shows how serious we are. We're doing this deal. But then for that time period, that 2 years, that 3 years, whatever it is, we kind of partner together where you have some responsibilities and you know what they are, and we have responsibilities and we know what they are, and we're working together during that time. You're still being able to glean some income off of that book, even though we've purchased it. And then at the end of that time frame, then we settle up on that remaining part that we left outstanding and figure out what we're going to do with any new business that you bought along the way. So, or sold along the way. So I think this little hybrid model is a work in progress. And we'd love to keep talking to you or anybody else that might have an interest in pursuing that a little bit. So those are kind of where we're at right now. And again, we love this business. We're excited about it. We think there's over the next 5 to 10 years, there's going to be a lot of guys, you know, in my age group and maybe a little older, a little younger, that are going to say, hey, I'm ready to do something else and want to take good care of my customers and get a good value. So having rattled all that off, the one thing that always happens is taxes.
How do I deal with this tax?
How do I deal with these taxes?
Yeah.
And you know what we told these guys a couple weeks ago, Andy, when Jeff and I were on here, was kind of coming up to this. All the deals that we've done so far, obviously you have to get into the tax piece of it at the time you put the deal together. And we kind of get down into the weeds with the person that we're talking with, and they've got their accountant and they're, you know, making sure everybody is good. But really it's such a big, and we've kind of avoided it. We've kind of just said, well, you need to talk to your tax guy.
Right.
You know, you need to talk to your guy because there's a couple different ways to do it. You want to do it the best way. Well, we just thought that's silly. We need to be a lot more proactive and bring in an expert. That's you, by the way.
That's me.
That's
okay.
you.
All right. Okay.
And let these guys ask you some questions, as well as you just explain it in simple terms that we can all understand how these different tax scenarios work for everybody, brother.
Sounds like fun.
That's your setup right there. I'm done.
Okay.
Yeah.
Okay. So we'll get started by just saying that whenever, no matter what business you're in, whenever there's a chance to sell your business, you know, is it going to be an asset sale or a stock sale? Is usually the first thing you have to think about.
Okay.
In the case of most of the people that are probably listening to this, I doubt if anybody has a C corporation,
Probably
where they're entering into these types of transactions. You know, if you're a Warren Buffett and you go out and you buy a business, you're going to buy stock. In our world, in the small business world, it's almost always an asset sale. I have run across a stock sale in these situations very rarely. So almost every time it's an asset sale. And so then the question becomes, what are you selling? So in the insurance business, you've got your computers, you've got a desk. What else do you have? You've got a book of business. Right. Is what you've got.
That's what you have.
Okay. So what you're selling is your book of business. And by definition, that is what we call either blue sky or goodwill, whatever you want to call it. But when you sell that asset, if you sell an asset like that, then you get what's called capital gain treatment. Okay, and so we're going to go now. Before we go to the next slide, though, one of the things that I've worked on this with a couple of different agencies that have been on the buying side, and when they've gone to make the deal with the seller, the seller is saying, "Hey, I would like to sell my book. I want it to be treated as capital gain." And the buyer says, "No way. We're not going to do that.
Yeah.
We're going to buy it. We're going to call whatever we pay you, we're going to call it commissions." And when we do that, that means that you as the seller are going to get clobbered.
Right.
That's the bottom line. Okay.
Right.
And we're going to go through an example that shows that here, I think on the next slide.
And let me just throw in right there, because all the deals that we've done so far, and you've helped us, but we've positioned them all as goodwill.
Right.
So it really, really helps the seller a lot.
It helps the seller tremendously to be able to value the transaction as goodwill. Okay, so we kind of talked about in this slide, we kind of talked about that already. So there's the hard assets. You might be buying a computer and a desk, and that's it.
Yeah.
We're not going to even count that.
No.
So it's so minor.
Right.
Those are called hard assets. Intangible assets in a typical structure like this is you're going to have, when you have a contract, you're going to have basically two things in that contract. One is you're going to be paying for goodwill. The seller is going to be selling goodwill. And usually there's a small carve out for a non-compete agreement.
Right.
Because in most transactions, you want to have a non-compete agreement to protect the buyer. And in Illinois anyway, there's been some court cases that have said that if you put a zero value on it or a very minor amount, that it doesn't really hold up in court to be a real non-compete amount. So generally you want to put something on there that's at least meaningful.
Like 5% or
Maybe,
so of the deal.
Yeah, maybe even a dollar amount, $5,000,
okay.
something like that. It just makes it meaningful.
I see.
Okay, so you want to make sure that that's included. And so the buyer wants the chance to have this transaction treated as a capital gain. That's what the buyer wants. A lot of times the seller says, no way, we want this to be treated as commissions, because when we do that, from a seller's point of view, they get to deduct whatever they pay immediately. Whereas if they buy goodwill, they have to, it's called amortization. It's the same as depreciation, but they have to take that value and depreciate it over a 10-year period of time. So if they buy $100,000 worth of goodwill, they can only deduct $10,000,
right,
or whatever it is divided by 15,
right.
$6,000 to $7,000 a year.
So like in our case, just not bragging on us. This isn't bragging, but just for clarity, it takes us the full 10 years before we can deduct
15
or 15
I
years.
said 10. I meant
yeah,
15,
that's what I thought. It takes us 15 years to get our deduction for what we paid for
That's
somebody's
right.
book of business.
Right.
Whereas if we did it, if it was as a commission expense and we paid them over 5 years, we'd get all our write-off over the 5 years.
Right.
Big difference.
It's a big difference for both the seller and the buyer, but by and large, the seller would just get clobbered.
Yeah.
And I'll explain that in a minute here when we go to the next slide. Well, maybe it's not the next slide. Okay. But okay, so we're going to talk about ordinary income versus capital gain income, and then how self-employment tax figures into it. And then we're also going to talk about how stretching out those payments can really maximize your tax benefits. Okay, so let's go through a couple of examples here. So this first example, you'll see in the left-hand column, it's labeled, this is via sale of $200,000.
Okay.
And in the left-hand column, the seller has insisted that this is going to be done on a commission basis. Okay. And then in the right-hand column, it's going to be that they've agreed to sell it and they're going to get goodwill treatment. But in this example, the seller is getting all their money up front in 1 year. Okay. So $200,000. Then on the left-hand side under commissions, there's, if you look down about 2/3 of the way, you see self-employment tax, $22,431. Whenever you pay self-employment tax, you get to deduct half of it. So that's going back up, that's the $11,216 deduction. Okay. So that gives you a adjusted gross income of $188,000. Before I get too far, I apologize for going through all the math on this. It's
where you shine.
It is. I hate doing it, but that's how we have to do it to kind of explain all this stuff. So you get to adjusted gross income of 188. Then from there, if you don't itemize your deductions, which a lot of people don't do anymore, because with the change in the tax law, a lot of people are doing just a standard deduction. And for a married couple, that's $24,800. So you get to deduct that. And then you also get a 20% deduction for what's called the qualified business income deduction. I'm not going to go through the math on that, but just know that in this example, it's $33,000.
Okay.
Okay. So under the commission type scenario, their taxable income is $131,000.
And these guys should all be used to this because they're commission salesmen. That's how they get paid now when they're paid as commission.
Right. They
right?
understand.
They should. They
Yeah.
should. They understand how the self-employment works, and
Mhm.
even if they don't understand it, it's what's happening.
Right,
It's what's
that's
going on. Yeah.
Yeah. Okay, so on 131,000 of income, if you file a joint tax return, your tax, just your regular income tax is 20,441. And then of course you have to, everybody, like John said, is pretty familiar with self-employment tax and how
Right.
that works. And so you also have to pay 22,431 for that. Of course, self-employment tax is Medicare and Social Security tax. So in this transaction, you've got a total of 42,872 of tax. And then in Illinois, this was set up for Illinois, you have $9,115 of tax, which is that's 5% of 188,784. Okay, so your total tax is almost $52,000.
Okay.
Okay, now go to the right-hand column. And again,
We treat it as
if
goodwill.
we treat it as goodwill, and again, you're getting all your money up front.
So it's going to be taxed under capital gains.
You'll be taxed at the capital gains rate, right?
Right.
Okay, so that's 200,000, you get the standard deduction, so your taxable income is 175,000. You're getting the capital gains rate.
So you don't have to pay any self-employment tax when it's capital gains.
Right. There's no
That's a
self-employment tax.
biggie for them.
That's a big deal.
Yeah.
Absolutely. So you're paying 14,280 in tax, and the state income tax doesn't change much for Illinois. And in most states, there is no distinction between capital gains and other income. It's just taxed at a flat rate.
Okay.
That's how it is in Illinois.
Yeah.
So in this scenario, your tax is 24,000. So you pay $28,000 more in tax because the buyer has insisted that it be taxed as commissions.
Yeah.
Okay.
Yeah.
Okay. You would never do this. You'd never really want to do it this
No,
way.
you wouldn't.
Okay.
No, you wouldn't. No.
Okay.
It's a huge deal.
Yeah.
Okay. So
Okay.
we've got some examples here.
So now what we're going to do is we're going to look at how this works. If instead of saying, I want my $200,000 all in 1 year, let's say you take $50,000 a year for the next 4 years.
Okay.
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 And of course, in most cases, $50,000 isn't going to be enough to live on.
Right.
So I as an example, I said, okay, the first year, we're going to take 40,000 out in whatever income it is, but let's call it an IRA distribution. Okay.
Yeah.
40,000 in year 1, 50
Yeah.
in year 2, 60 in year 3, and 70,000 in year 4.
Okay.
Okay. Okay. So in 2020, you got your 50 from the sale of the business that's taxed as goodwill.
Right.
You got 40,000 of IRA money that's going to get taxed as ordinary income.
Right. And you're just using that as an example to
Just
kind of
as
get
an
their
example.
income back up close to where it was.
Yeah. Right.
Yeah.
Okay. So your total income is 90,000. And again, I'm doing all this for a joint. The things are different if it's single, but I'm going to use a joint tax return.
All right.
Okay. So then you got a standard deduction of 24,800. So you're going to pay tax on $65,200.
Okay.
Okay. So we'll come back to this slide in a minute, but I want to continue on with it. So we can go to the next one. Okay. So it's 65,200. I get questions all the time on, you know what? I've heard capital gains are taxed at 0%.
Right.
I've heard capital gains are taxed at 15%.
Exactly.
I've heard capital gains are taxed at 20%.
Mm-hmm.
And in my world, you know what?
It's all true.
It's all true.
I knew you was going to say that.
I get, people say, well, how much is the tax? And like a lot of us have to do all the time and say, it depends,
Mhm.
So what we're going to kind of do is go through this and show you how. I hate to go through the math, but this is how it works. So you've got taxable income of 65,200 from the previous slide. Your capital gains income is 50,000. So you're going to have $15,200 that's taxed at an ordinary tax rate, which in this case is some in the 10% bracket, some in 12%. Okay. So it comes out to be 1,523.
Okay. So let me just make sure I got it. So in that case right there, that exact example, that guy's got 65,000 plus of income because he added a little bit of taxable income because he took some money out of his IRA, but he's only paying $1,500 in taxes that year.
So far.
We're
not done yet.
Okay.
Okay.
All right.
All right. So 1,500 of taxes on ordinary income.
Okay.
Okay. And actually, you're right, John, but we gotta make sure we get there. Okay. So then what the tax code says, if they have a threshold, we're just going to call it a threshold of $80,000 to compute how much capital gains tax you got to pay.
Okay.
80,000 is the 0% threshold for capital gains tax.
Okay, so let me stop right there. So if the capital gains, you call it income?
Mm-hmm.
So your capital gain, your income from capital gains, if it's under 80,000.
Okay, no.
No.
If all of your income from capital gains, all of it
Mm-hmm.
was $80,000, you pay zero tax.
Okay.
You're in a 0% bracket.
All right.
Okay. But what we're doing here is we're saying, okay, you've got 80,000 is your threshold.
Mm-hmm.
That's just a number.
Okay.
Your income that was taxed at ordinary rates from up above was $15,200.
Mm-hmm.
So that means that you can have $64,800 of income from capital gains, and you're in the 0% bracket. Okay.
Okay.
Has that got it?
Yeah.
Okay. So now go down one more slide if we can. So you've got 50,000 of capital gains. You're 64. You can have $64,800 of income from capital gains taxed at 0%.
Mm-hmm.
So that means none of your capital gains are taxable.
Hmm.
Okay, let's go quickly to the next one. Next slide. So you've got $1,523 of taxes at ordinary rates,
Mhm.
zero taxes at the capital gain rates. You were right, 1,500. You want to come to the office and do taxes?
You know what? I think I might.
Okay. So you had $1,523 of tax on $90,000 of income.
Yeah.
Which means you're paying a 1.69% rate.
That's beautiful, isn't it?
In my world, that's a pretty good deal.
Capital gains is your friend,
Yeah.
isn't it?
Yep.
Hmm.
Okay. Now we're going to go back up a few slides there. That one, Jason. Yeah, the one right after this one. Okay. Let's skip that column because it's basically the same as what we just went through. Let's go to the 2023 column. Okay, so same scenario. We got 50,000 of gain from goodwill because this is getting paid out over a 4-year period of time. So each year, the seller counts it as $50,000 worth of goodwill. Okay, we've got IRA distributions of 70, so we got total income of 120,000. Our standard deduction is scheduled to go up a little bit every year. It'll be more than that by 2023, but that's what we know right now is what it's going to be. So taxable income is $94,900. Okay. So $94,900. Capital gains is $50,000. So the income tax at the ordinary rate is $44,900. Tax on that is $4,993.
Okay.
Okay. Now, our threshold
Is 80.
is $80,800. We've had $44,900 of income taxed at ordinary income.
Right.
So that means we can have as much as $35,900 taxed at the 0% rate.
Mm-hmm.
Okay, so let's go to the next one. So 50,000 is our capital gain. We can only have $35,900 taxed at the 0% rate, which means the remaining $14,100 is taxed at 15%.
Oh.
Okay, so there you come down to $2,115.
No.
So go to the next slide, Jason. And so here you've got $4,993 plus the $2,115. So your total taxes are $7,108 based on $120,000 of income. You're paying a 6% rate.
Yeah.
Still not a bad deal.
Not a bad deal at all.
Yeah.
No, it makes so. I'm not saying, I mean, it's a little bit complicated, but it is such a big deal for these guys. Whenever you sell your book, whether it's to us or whoever it is, that you want to fight to make sure that it's positioned as capital gains.
I think you do. And I think this demonstrates with some planning, and people would really have to plan with their accounting person and their tax person,
Yeah.
You know, to kind of plan this out, because it's if you're going to do this over a 4-year period of time and you want to get into these low brackets, you've got to live off, some off your savings possibly to get there, or live off, a small amount of
Right.
IRA money or some other income that may be coming out
Yeah.
that's being taxed.
Yeah.
So it does, I guess the point, really the big point is, planning can really pay dividends here.
Yeah. Yeah.
Okay, we do have a question. If I sell my business, will you send me a 1099?
If New Horizons buy your business, they are only required to send 1099s for personal. There's like 9 or 10 different categories that they're supposed to send you a 1099 for, including personal service, and the answer is no.
Yeah.
You do not.
So
have
what
to
do they
sell.
do then? What do they give to their tax guy if it's been treated from our side as capital gains? We're all on the same page there. What do they show?
They just have to tell them, here's the transaction and here's how we're doing it. Give their tax person a copy of the contract, for example.
Yeah.
But there's no reporting to the IRS.
That's
that goes with
beautiful.
this. Yeah.
And I'll say this, guys, all of these things are obviously contractual. We don't just, these are big, this is a big deal to everybody. It's what you've worked
Mhm.
in most cases, most of your career for to build this business up. So it's all written out. It's all contractual. We have it written in that we are considering this goodwill from our end, right?
Yeah.
Now, if the IRS ever would treat it differently, we can't stop that, but we've never had any issues with it.
Yeah, and I don't think so. As long as the chances of the IRS contesting a transaction like this are practically zero, because number one, you're doing it with third parties. You're not doing it with your son or
No, right.
your dad or somebody. It's
Yeah.
not. These are not related party transactions. So both sides have agreed to do it this way.
Mhm.
And the other aspect is, when you sell a book of business, it's right in the code that this is it's called Section 197, that this is an intangible asset that's subject to capital gain treatment. So there
Yeah.
is really no chance that the IRS would look at it and say, no, you got to treat it as ordinary income.
Okay, how do you value a business?
Is that any business, or is it specific to, I'm sure it's specific to the insurance industry. So John, you want to
Yeah, well,
go on that one?
yeah, I'll take a swing at that one. The businesses that we're looking for, the ones that we've acquired so far, are all renewable income products, like a MedSup. They've been very, very heavy MedSup, could be Med Advantage too, but something where there's a recurring income stream. So we look at what that income stream is, and then we place a multiple on top of that, whatever that might be. It might be from 1.5, we've never gone that low, to maybe 2.5 on the high side, and everywhere in between, depending on what the book is made up of. So I hope that answers it. But we look at your income that book is making to you right now. What's the income today on that book? And then we sit down and say, okay, this is the age of the book. That's how old these customers are. If it's a MedSup primarily book, and then we come together on what we think the multiple's fair. But we feel a real added perk, and there needs to, this isn't bragging, that's not the right word, but it's really got to be weighed into consideration. Taking it as capital gains, honestly, it's a negative to us, right? Because it takes us 15 years to deduct whatever we pay for that book. Whereas if we did it as ordinary income, it would really clobber the seller out there. But it really favors us because we get to have the write-off in the 4 or 5 years or whatever it is that we agreed to pay it out over.
Yeah, it's definitely it's a big advantage for the seller, I should say. The buyer gets has to wait a long time to get all the deduction for it.
Here's my buddy Holly Roberts. It says, so in your example, would the 50,000 be shown on Form 1040 line 6? Holly acts like he really knows what he's talking about.
Well, Holly, I don't know what line it is.
Holly's a guy.
Okay.
He's a good man, good guy.
Yeah, I'm not sure what line it is. Our software could tell you, but I don't know exactly.
You got him, Holly. You got him. You stumped him.
But where the mechanics of it is, the gain is actually reported on. There's a form called 8949, and that flows through to what's called Schedule D, and then Schedule D flows through to the line on your return. So it'll show up on your tax return. It's right there. That 50,000 is right there. But behind the scenes is where all the tax calculations take place. And you don't see a form for that. We have a schedule that we use to do that, but you will not see a form where the tax is actually calculated when you have capital gain like this in the example.
How about that, Holly? Okay, you want to read them?
Sure. Larry asks, can you sell Medicare Advantage and Medicare Part D book of business?
You can, and Larry, some of the books that we've bought had Part D in it, and we put a value on it, and that's tough, man. I mean, that Part D that's a tough one, but we look at it together and really try to be fair to both sides, and Medicare Advantage as well, for sure. Maybe your question is what you're getting at is like there's some companies, some carriers that make it a little bit more cumbersome to transfer that Medicare Advantage book because there's certifications and but we've done it. Yeah. And we helped on a book on a local agent that died last year suddenly, and we helped their family. We got involved to help. We didn't buy it, but we helped them. And I know we had to jump through some hoops to satisfy that, but long answer just to say yes. Ann says, nice explanation on the taxes. Very clear. What section of the tax code did you reference?
Okay, that when there's when we're talking about intangible assets, those are referenced in code 197 of the Internal Revenue Code.
Okay. Okay, you want to read it?
We've got a question. Do you have any experience filing an 8594?
Yes. Okay. What an 8594 is whenever there's a transaction like this.
The old 8594.
The old 8594. You want to explain it?
Yeah, that was like my favorite play in high school on our football team.
8594.
On
okay.
two. We're going out on two.
Okay.
Yeah.
Okay.
No idea.
Okay. Form 80. That's a good question. Form 8594 is a form that the IRS uses when there's a transaction like this, when there's a sale of a business. And what the form does is it tells the IRS that the buyer and the seller both fill out the form. Each one of them has to fill it out. And it tells the IRS that, hey, this is we sold this business for X number of dollars, and this is how we allocated the assets when the business was sold. And in this case, if all of it goes into goodwill, it'll just be one line that shows how much. In the example, we use $200,000. Okay. And it is a form that both the buyer and the seller have to file with the IRS. And that way, the IRS knows that there's been a transaction that's happened.
I see.
Okay.
That it?
That's it for now.
Well, brother Andy, thank you, man.
You're welcome.
You made it fun and easy.
I don't know about fun. I know about easy, but it was we gave it a shot.
Thank you, brother. Yeah. Well, thank you guys. Thanks for listening again. We're here every day. You know that. Anything we can do to help, just shout.